Hey guys, how's it going? My name is Jason Sari. I'm a financial advisor with the Premier Client Group. On the side, I run this YouTube page and a Facebook group called Financial Education for Retirement, just to help foster financial education to anybody I can reach. But let's get into the video today on Roth contribution limits for 2025. Beforehand, though, guys, just as a disclosure, this video is only general explanations and education. There is no concrete legal advice, tax advice, or investment advice throughout this video. Please contact a legal representative before acting on any information you've seen or heard in this video. All right, guys, so what is a Roth IRA? Now, it is highly regarded as one of the best retirement accounts you could possibly have. And with this, one of the best benefits is the tax-free withdrawals and the tax-free trading and growth. So what makes these accounts so special? Why are you allowed to trade tax-free in them? As you know, with the brokerage account, you have to pay short-term capital gains or long-term capital gains, depending how long you hold a stock, ETF, mutual fund, whatever it may be, when you are trading in a normal brokerage account. But with a Roth IRA, with any IRA for that matter, you can trade tax-free completely as many times as you want throughout the year, no matter what. Now, the reason the IRS lets you get away with this is because these are retirement accounts. A Roth IRA is a retirement account. There are certain restrictions that don't apply to brokerage accounts that apply to Roth IRAs. First being the contribution limit. For 2025, the contribution limit for a Roth IRA is the lesser of 100% of earned income or $7,000 with a $1,000 catch up once you turn 50 years old for a total of $8,000. Now, this can't just be any income. It has to be earned income. Now, earned income is income you earned from a job or active participation in some sort of job or employer. You have to be employed. You can't get money from, let's say, your parents if you're a kid and put it into a Roth IRA. You can't put money from Social Security or a pension into a Roth IRA. It has to be working, actively working, earned income. This is a big factor because let's say you're a kid and you make $3,000 for the year from your job, from whatever it might be, but you have $50,000 in the bank account, you can't contribute this $7,000 limit. You can only contribute $3,000 or the lesser of 100% of your earned income or that $7,000 limit. So it's a big thing to keep in mind when contributing to these kinds of accounts. Same thing goes for when you're retired. If you're retired and you're only living off of Social Security or a pension, you cannot contribute to any type of IRA whatsoever. Another limit for these types of accounts is on the upside as well. If you make over a certain amount per year and you file taxes singly, married filing jointly, or married filing separately, you can't contribute to a Roth IRA. I'll put them in the top corner, but if you make over a certain amount, you can't contribute to a Roth whatsoever. There's a ways around it, such as a backdoor Roth IRA, which involves a traditional IRA, but there are income limits on the upside as well as income limits on the downside. These restrictions are for nothing more than the IRS to have a hold of what goes in and out of the account, who can contribute, and to make sure that people aren't taking advantage of the benefits of the Roth IRA. So then what separates a Roth IRA from a traditional IRA? Now, that is the way money is put in and the way money is taxed when it is taken out. So with a Roth IRA, that is a post-tax account. First, you get taxed on your money you get from earned income, and then that money goes into the Roth IRA. With that being said, when that money comes out of retirement, that money is then completely tax-free when it is distributed to you. With a traditional IRA, the money is put in pre-tax. It does not get taxed before it goes into the IRA, therefore it comes out and it is taxed. So with these accounts, it really matters on your tax bracket currently and where your tax bracket is going to be at retirement. If right now you are in a lower tax bracket than you will be at retirement, it is a fantastic idea to contribute to a Roth IRA because if you get taxed on the money now, when you are in that higher tax bracket at retirement, you won't need to worry about taking the money as distributions and getting hit with that higher tax. While as for a traditional IRA, if you are in a higher tax bracket now, it makes sense to put the money in pre-tax and then get taxed on the way out at retirement at that lower tax rate. Now, another difference between these two accounts is RMDs, required minimum distributions. Now, a required minimum distribution currently has to be taken at 73 years old from a traditional IRA. It is based off life expectancy and the total amount in your IRA. With a Roth IRA, you do not need to take a required minimum distribution at all. So if you're retired and you don't need the money from your Roth IRA, you don't need the money from your traditional IRA, you just want to let them sit and give them to your heirs. You cannot do that with a traditional IRA, but you can with a Roth IRA. A traditional IRA will force you to take a distribution every single year starting at age 73. But since the IRS already taxed the money in a Roth account, they do not care and they do not make you take that required minimum distribution. A big factor with this as well is that traditional IRA distributions, whether they are RMDs or normal distributions, they raise your tax bracket based on the amount you take. So if you're in a very low tax bracket, but you take an enormous distribution from your IRA, you will be taxed on the tax bracket after that IRA distribution is into effect. Whereas, of course, with a Roth IRA, you are not taxed whatsoever. Therefore, that distribution will not raise your tax bracket. Another limit with these types of accounts is the 59 and a half rule. For a Roth and a traditional IRA, you cannot take money out penalty free before age 59 and a half. If you take money out before age 59 and a half, if it's a traditional IRA, you will get taxed and hit with a 10% penalty. With a Roth, you will get hit with a 10% penalty, and dependent on the type of money you take out, you could be taxed as well. The interesting thing about a Roth, though, is that at any age whatsoever, for any reason, you can take out the principal, the money you put in, completely taxed and penalty free. So if you want to buy a car for $20,000 and you're 30 years old, you put $30,000 of principal into your Roth IRA, but it's worth $60,000, you can take that $20,000 out completely tax and penalty free. No restrictions apply. Now it gets tricky when you go into the earnings. So if you wanted to buy a $60,000 car, let's say, with that same IRA, you only put $30,000 in, but you need $60,000. Even though the Roth IRA might be worth $60,000, if you take the whole $60,000 out, you will be taxed and penalized above the basis what you took out of the Roth IRA. There are some special instances where you can take out earnings in a Roth IRA tax free, like for a first time home, I think some health issues and some other stipulations. But you do have to look into that beforehand because you, of course, don't want to get hit with tax and a penalty when you're withdrawing from one of these retirement accounts. It's a very negative thing, and you really shouldn't want to do that at all in a retirement account. Once you put the money in, let it sit. That's what it's for. Don't touch it until you're over 59 and a half. You don't need it anyways, hopefully. Moving on, before I said that a big plus with these accounts was that you could trade tax free. So once you put the money, once you put your $7,000 a year into this account, you can buy and sell whatever you want completely tax free. Mutual fund gains get kicked off to you tax free. Dividends, tax free. Bond interest, tax free. If you sell a stock, it's completely tax free. You don't pay transactional fees or transactional tax for stock in an IRA whatsoever. Also, with IRAs, since they are set up by yourself as an individual, you have many investment options as far as what you can buy and sell in these IRAs. Pretty much anything you can in a brokerage account. Now, with the 401k, an employer sponsored retirement plan, you are restricted to what is actually available in that plan. And it could be very little sometimes. But with an IRA, you can buy any stock, mutual fund, ETF, index fund, really whatever you want. You can even buy annuities in IRAs. Just to go back to contribution limits real quick though, just to clarify, you can't contribute $7,000 to both a Roth and a traditional IRA in the same year. You can only contribute a total of $7,000 to both. You can do 50% to one, 50% to another, 20% to one, 80% to another, or 100% in one, but you cannot do a total of $14,000 across two IRAs. You can only contribute $7,000 across any IRAs that you have. There is a loophole around this though if you have a spouse. If you have a spouse and you're married filing jointly and you're below the phase out for a Roth IRA or traditional IRA, you can contribute for both you and your spouse if you're the only one working. So if you have an unemployed wife, but she but you make $200,000 a year and you are looking to contribute to a Roth IRA, you can contribute $14,000 across two IRAs, one for you and one for your wife, a spousal IRA. I know this goes against everything I just said about having to have earned income, but this is a loophole. Your spouse does not need to have earned income. If your wife or if your husband is the sole income earner and you are unemployed, you are just a stay at home, whatever it may be, unemployed between jobs, you do not have to have earned income for your spouse to contribute to a spousal IRA for you. Going along with earned income, again, though, there is no age limit to contribute to an IRA, a Roth IRA, or a traditional IRA. As long as you have earned income, you could be 12 years old and still contribute. It has to be custodial, but still, there is no age limit to where you can't contribute to an IRA. Lastly, we'll go over contribution deadlines. Now, for a 2025 IRA, you can contribute anytime from January 1st all the way to April 15th of 2026. You have that whole entire tax year per se to contribute to an IRA for 2025. Otherwise, guys, I hope you enjoyed the video today. I know there was a lot of information. Feel free to go back and watch. I also have other videos specifically for traditional and Roth IRAs, getting more in the weeds about the differences between them and different types of limits and so on and so forth. But again, feel free to check out the Facebook group Financial Education for Retirement. It's linked in the channel description. It's a great platform. There's certified financial planners as group members willing to answer any questions at pretty much any time of the day. Otherwise, guys, have a great day. Enjoy the rest of the videos and make sure to like and subscribe.